The cryptocurrency market has once again been thrown into chaos, and this time, it's not just a small correction, it's one of the biggest crashes in recent history. Bitcoin has dropped over 40% from its recent highs, Ethereum has plunged below key support levels, and altcoins across the board are bleeding red. Billions of dollars have been wiped out in a matter of days. But what's truly causing this massive crash? Is it market manipulation, regulatory fear, liquidation cascades, or something far deeper brewing beneath the surface? Today, we're breaking down exactly what's happening, why it's happening, and most important, social comes next. Let's start with the numbers. In the past week alone, the global crypto market capitalization has fallen from over 2.5 trillion to just around 1.4 trillion, erasing more than 1 trillion in market value. Bitcoin, which was trading near the 70,000 level just a few weeks ago, has now slipped below 40,000, marking one of its steepest corrections since 2022. Ethereum, which was holding strong around 4,000, is now struggling to stay above 2,200, and other major coins like Solana, Avalanche, and XRP are down anywhere between 40 to 70%. The fear in the market is palpable, so Twitter is in panic mode, exchanges are facing heavy withdrawal requests, and stablecoin liquidity is drying up fast. But here's the big question everyone is asking: why did this crash happen? Well, it's not one single factor, it's a combination of multiple dominoes falling all at once. First, there's been a massive wave of regulatory pressure coming from major governments around the world. The U.S. SEC recently launched new investigations into major crypto exchanges, hinting at potential lawsuits over unregistered securities trading. At the same time, the European Union has tightened its rules on stablecoins, limiting the issuance of algorithmic or unbacked tokens. Even Asian markets, once known for being crypto-friendly, are starting to crack down on unregulated trading and high-leverage derivatives. Then, there's the macroeconomic backdrop. Inflation numbers in the U.S. and Europe came in higher than expected, pushing the Federal Reserve and other central banks to maintain higher interest rates for longer. That means risk assets like crypto become less attractive compared to bonds or cash. Investors are pulling money out of speculative markets and parking it in safer assets. When big institutions start offloading crypto holdings, it triggers massive liquidation cascades in the derivatives market, where billions of dollars are often leveraged on price movements. Once those liquidation bots start firing, it's like a domino effect, one sell triggers another, and before you know it, the market is in freefall. But there's another side to this crash that few people are talking about. Whale manipulation and institutional shakeouts. Large holders, often called whales, tend to use fear, uncertainty, and doubtful we call FUD to trigger panic among retail investors. They push prices down, force small traders to sell at a loss, and then quietly start accumulating again at much lower prices. We've seen this pattern play out before in 2018, 2020, and even during the 2022 bear market. Every time retail panics, institutions buy. Every time the headlines scream crypto is dead, smart money gets back in. So while the charts might look terrifying right now, there's a real possibility this crash is not the end but the setup for the next major bull run. Let's dig deeper into some on-chain data. According to Glassnode and Sentiment Analytics, long-term Bitcoin holders that haven't moved coins in over 6 months are actually increasing their holdings during this downturn. Meanwhile, short-term traders and leveraged accounts are the ones getting wiped out. That's an incredibly bullish signal in the long term. Historically, Bitcoin bottoms out when weak hands sell and strong hands accumulate. If history repeats itself, this could be the accumulation phase that sets the stage for a major rebound in 2025. Still, that doesn't mean the pain is over yet. The short-term outlook remains rough. Altcoins, especially low-cap or speculative ones, tend to crash harder and recover slower. Many projects will not survive this bear cycle. The DeFi sector has already seen liquidity drained by over 60%, with major protocols losing billions in total value locked TVL. NFT markets have also cooled off dramatically, with trading volumes down over 90% compared to their peaks in 2021. The sentiment across the board is fear, and as the saying goes, when there's blood in the streets, that's when opportunity is born. But let's zoom out for a second and look at the bigger picture. Every major crash in crypto history has been followed by an even stronger bull market. In 2013, Bitcoin crashed from 1,200 to under 200, then rallied to 20,000 in 2017. In 2018, it dropped again to 3,000, before soaring past 60,000 in 2021. So what causes these cycles? it's all about market psychology and technological adoption. When prices go parabolic, retail investors flood in with FOMO. When they crash, fear takes over and everyone leaves. But during those quiet, forgotten years, builders keep building. Layer 2 solutions like Arbitrum, Optimism, and Skyking, decentralized AI networks, and next-generation blockchains like Celestia and Monad are continuing to evolve. The innovation doesn't stop, even when prices fall. That's why every bear market lays the foundation for the next bull run. Now, let's address another major factor in this crash: ETF cycle and institutional rebalancing. The approval of Bitcoin and Ethereum that's brought a wave of institutional money into the space, but it also introduced new volatility. Institutions buy when it's cheap and take profits when retail starts buying high. As those ETFs reached record inflows earlier this year, it was only natural for some funds to start taking profit, especially as global markets showed weakness. When institutions rebalance portfolios, even a small shift in allocation can move billions of dollars, amplifying the crash. On top of that, the crypto market has become heavily interconnected with traditional finance. Stable counters like USDT and USDC are backed by U.S. Treasuries, meaning macroeconomic shifts in interest rates directly impact crypto liquidity. When yields rise, stable balloon issuers make more money holding cash, reducing their incentive to inject liquidity into exchanges. Less liquidity means more volatility, which we're seeing play out right now. So where do we go from here? Is this the end of crypto or the beginning of something new? The truth is, this is a cleansing phase. Overhyped projects will die. Scams and unsustainable economics will collapse. But strong projects with real utility, solid communities, and long-term vision will survive and thrive. Bitcoin remains the most secure decentralized network in the world. Ethereum continues to dominate smart contracts, and emerging ecosystems like Solana, Near, and Avalanche are making real progress in scalability and developer activity. In the coming months, we could see continued volatility, possibly even lower lows before a full recovery. Historically, Bitcoin tends to bottom out 12 to 18 months before the next halving, and guess what? Next halving is just around the corner in mid-2020s. That means this crash could actually mark the beginning of the accumulation zone before the next bull cycle. Smart investors and long-term believers are already preparing for that moment. So what should investors do right now? First, panic. Panic selling during a crash is how you lock in losses. Instead, zoom out, study historical patterns, and think long-term. Secondavispri. Don't put all your funds into one coin. Spread your risk across sectors like Bitcoin, Ethereum, AI-based tokens, and DeFi blue chips. Third, keep cash ready. Crashes like these are when fortunes are made. Buying during fear, when everyone else is selling, has historically been one of the best strategies in crypto. There's also a broader philosophical takeaway here. The crypto market was never meant to be a get-rich-quick scheme. It's a long-term revolution in finance, technology, and decentralization. These crashes serve as brutal reminders that volatility is the price you pay for being early to a global transformation. If you believe in the long-term vision of decentralized finance, Web3, and blockchain innovation, then this crash is not the end of the story. It's simply another chapter in the crypto evolution. Let's not forget what's happening behind the scenes. Governments are racing to issue their central bank digital currencies BDC, while major corporations are exploring blockchain integrations. Countries like El Salvador and Argentina continue to adopt Bitcoin at the national level. Meanwhile, developers are pushing forward with zero-knowledge proofs, decentralized storage, and AI-driven blockchain systems. All of these are signs that the crypto space is maturing, even if the markets don't reflect it right now. So what happens next? In the short term, instead volatility. Bitcoin could dip further before stabilizing. Altcoins may continue bleeding. But long term, the fundamentals are stronger than ever. The number of Bitcoin addresses holding more than 1 BTC is at an all-time high. Ethereum's staking continues to grow. DeFi and AI tokens are finding real-world use cases. Layer 2 scaling solutions are improving transaction speeds by 1x. The next bull market will likely be built on real utility at hype. When you look back 5 years from now, this crash might not look like the end of crypto. It might look like the greatest buying opportunity of the decade. History doesn't repeat, but it does rhyme. Every crash feels like the end, and every recovery feels impossible. It happens. The strongest investors are not the ones who predict the future perfectly, they're the ones who survive the downturns and stay focused on the long game. In conclusion, The BIGGEST cryptocurrency market crash we're witnessing is painful, yes, but it's also part of the natural cycle of innovation and adoption. It flushes out the greed, resets valuations, and creates space for genuine progress. If you stay informed, stay calm, and think long-term, you'll not only survive this crash, will be positioned to thrive in the next bull run. Because if there's one thing crypto has proven over the years, it always comes back stronger. So buckle up. The storm isn't over yet, but behind every crash is a new beginning. The question isn't will crypto recover? The real question is, are you ready when it does?